Hey guys, Stockaholics, thanks for being here today. On this channel, over the last several years now, I've been talking about oil tankers and shipping investing in general. I've been pretty quiet on this space and especially oil tankers for over a year now. And I wanted to come back, I wanted to revisit the investment case I had for oil tankers, give some of my thoughts around that, how the investment has done, and then ultimately whether or not I think today the investment case for oil tankers is still there. Okay, when I started making videos on my channel about oil tankers, the tanker market was terrible. The shipping was in the doldrums. We were kind of dealing with COVID lockdowns. Oil demand was terrible. There wasn't any positive catalysts in the tanker market for oil tankers at the time. And the stocks were trading at all-time lows, both in terms of their share price, but also in terms of their assets and the stock in relation to those assets. Since then, over the past couple of years, they've done extremely well. The conditions have changed in the market. And on this screen here, I've put together a basket of, I just put a bunch of random stocks in there. And if you had bought a basket of these random stocks and you bottom ticked it sometime in 2021 to you held them until today, you'd be up 430% on the basket of these stocks. For myself, I was heavily skewed in my investment towards companies like Frontline and DHT. I've held some companies like INSW, ASC, and Sting for a while. So I don't know exactly. I could go look at my overall investment percent, but it's probably somewhere around here because I had a basket of more or less a bunch of random names, right? And so for me, this has been a very good investment. It's probably one of my best investments over the years, and it's great. But again, it's a cyclical investment, right? So now that things are starting to look good, you kind of have to start and ask questions. Okay, well, things aren't terrible anymore. There's a lot more optimism in the market. The optimism is being reflected in the stocks. And so as we're thinking about it in terms of cyclical investing, is it still good and still a good investment? I wanted to quickly revisit why was it that I decided to buy these tanker stocks in the first place, right? Well, being a cyclical industry, shipping, I noticed that the shipping stocks overall, at least for the last decade or so, with a few short exceptions, they've done extremely poorly, right? And so when we're thinking about it in terms of investment, there's conditions that say, okay, well, why has it been so terrible, and can that change, right? And so when I was looking at investing, there's a few things that stood out to me. The first thing was that the price of these ships and the stocks were extremely low. So the prices of these ships, they fluctuate up and down through the out there shipping cycles. And when we were in the pandemic, the ships were trading at all-time lows. When we looked at the stocks and we compared them using a valuation metric called price to NAV, we could also compare that not only were the ships themselves trading at extreme lows, but also the stocks themselves were trading at fractions of the value of their assets. So you could actually go and buy these stocks for way less than the value of the sum of all of their ships, which is, looking back on that, is kind of a crazy thing to see, right? And so there's also some other dynamics, right? Where we're looking at supply. We were saying, okay, well, there's not a lot of supply coming. We're looking at the age of these ships. They're increasingly getting aged. There's increasing inefficiencies in the market. And although the market is terrible right now, it doesn't seem like that will be the case forever. These things are priced for death, but at some point we can say, okay, these are going to be priced better because the market is going to change. Okay, and things changed over time. They didn't happen at all like I thought that they would. I think that the idea was that, okay, there's going to be some kind of demand change, that there'll be a point where the supply will come up when it'll shrink to a point, or the inefficiencies will increase to a certain point in the market or demand will increase to a certain point in the market where these stocks, the rates that drive these stocks will ultimately increase. And that's not at all what happened. And if anybody says something different to that, I don't, well, they can just refer to this chart here. Okay, so what we're looking at, this is Baltic Dirty Tanker. This is kind of an index of at least the dirty side of oil tankers. And from what I understand, this is more skewed towards some of the smaller segments in the space. So I think your Aframaxes, your some Suezmaxes, but less your VLCCs, right? And there's been again, another kind of a split between markets over the past couple of years. The VLCCs, the biggest ships, which you wouldn't expect, have kind of underperformed, and then the smaller ships have kind of outperformed. But in any case, right, this chart is showing, going back to when we were in the doldrums in 2021, there wasn't a lot going on. There was some green shoots in 2022. It was starting to look that, now that we're getting out of this pandemic, demand is increasing, the rates are getting out of a place where we're at all-time lows. But they didn't really start shooting up until a catalyst took place, and that was the Russian invasion of Ukraine. And it wasn't, even to add some even more color to that, it wasn't initially it was the invasion itself. You can see that in the spike in rates here. But what drove this sustained rally over the next year and a half or so, and even the market till this day, is the response that we had from the European Union. So it's not that first order effect of these tanks rolling into Ukraine, it's the response from politicians across Europe and how they wanted to decide to kind of fight back against that invasion. And they decided to do that in terms of not directly buying Russian oil anymore. So what that did is a lot of that Russian oil, instead of it getting directly transferred to Europe on short routes or through pipelines, a lot of that oil instead got exported from Russia and got transported through very long haul routes to places like India that got refined there, and then it got sent back into Europe. So it added an extraordinary amount of inefficiency into that market. It's hard to say, when looking back on this drop here, and maybe it was because there was increased efficiencies being added, the market was starting to adapt to that invasion. I would say that it probably wasn't. Maybe I think there's kind of this big push and this pull in terms of demand. And I think that this dip that we saw here, where it kind of mean reverted, might also have been seasonal. But if we're looking at it, it could be either one, right? I don't know for sure, right? But then shortly thereafter that, in late 2023, well, there was that problem that happened in Israel where Hamas came over. I'm not going to get too much into the details on that, but some terrible things happened. And as a result of that, the market in the oil tankers, started doing extraordinarily well. It quickly rebounded beyond what we would expect from primarily seasonal factors, right? And those conditions for that, again, we're not talking about first order effects. Again, initially there were first order effects, but the second order effects from that were that, okay, now that there was some aid going to Israel, or at least in the terms of the perception of some Middle Eastern participants, I guess we would say, the people in Yemen started shooting rockets at ships because they weren't happy with how the war was taking place, and I guess that's kind of a fancy protest that was happening, where they wanted to stop Israel from getting shipping, and they wanted to kind of make the world support the Gazans and the Gazan Strip in terms of aid, right? And so what that has done over time is that's reduced the amount of ships going through the Suez, which has had dramatic effects across all segments in shipping, and also the oil tankers. And as a result, for the past year or so, because of probably both of these two effects, the Russian invasion response to that, the Hamas-Israel conflict and other participants' response to that, the oil tanker has seen a sustained rally. Another way you can quickly see that is this chart. This is oil tankers at the Suez Canal measured from January 2023 all the way up until today. I took this from Jay Hanesal on Twitter. I'll put a link. I would recommend following him. He is a shipping investor. He manages a fund. So I would take his motivations with a grain of salt, just like I would recommend that you take my own recommendations with a grain of salt. Yeah. But you can quickly visualize that the change of ships going through the Suez Canal, which is kind of one of the arteries in terms of shipping, has been declining. I think the year-over-year change in ships going through the Suez is about half, right? And so that has reverberating impacts in terms of rates, right? If there's less ships available for transport because more ships are being tied up for longer routes or because they can't go through here anymore, then that causes inefficiencies, and again that causes rates and as a result these stocks to go up. Okay, so what's been driving the market? I think it's clear to say that over the past couple of years it has been geopolitical driven. It hasn't been what I had thought would drive the market, the supply and demand fundamentals of tankers. And so when we're thinking about an investment here, one of the key questions we'd have to ask is, are these geopolitical conditions going to continue? Is the Russian war going to continue, or is the response more, the second order effect? Are the Europeans going to continue to not buy Russian oil? Well, I don't know. I have no idea, right? And when we're looking at Israel, is the Israeli conflict going to continue? And then the second order effects of that. Are these Houthis going to continue to lob rockets into the Suez Canal, right? Well, I don't know. And I think if we're being truthful, nobody knows. Even if you're Peter Zeihan, you're the guy in the corner store, or anybody out there, I think the answer to this is that we don't know, right? So when we're thinking about rates, well, we know that the rates are driven, and the stock price appreciation and where they are today and the earnings that they have is driven on these geopolitics, right? So what's really hard for me about these now is that the investment case, I think, is predicated on geopolitical considerations that are unknown, right? And so I think what we have to try and do is kind of get those out of the way and think about these in objective ways and financial ways, and think about them in terms of price. Okay, quickly before I talk about price on these stocks and these ships, I want to talk about the order book. We look at supply, right? And does the supply look alarming? Is the supply growing? Well, first of all, the supply, yes, it is growing, but would I say that it looks alarming? I would say no, probably not. Is there different segments that are growing rapidly? Yes, the product tanker segment has been growing, but I think a good way, and this is how I've done it, and it hasn't been maybe not accurate to the way that the market has turned out, but is in terms of deadweight tonnage, and it's also in terms of both of these segments, because despite what a lot of people say, if you look at the rates between clean and dirty over long periods of time, they correlate very highly. And that's because you can switch a crude tanker depending on what it is to products with some effort. And you can also switch a product tanker into crude depending on type with a lot less effort. So it's important, I think, to think about this in terms of an average between these two fleets, right? Now, the product tanker fleet in terms of deadweight tonnage is a lot smaller. So you probably want to weight this crude tanker percentage higher. The other thing to consider is that the order book is over multiple years, right? And in 2024 and 2025, the amount of ships delivering will be extremely small. However, in 2026 and beyond, I would expect that it is going to be high. And based on where rates are now, that'll probably continue to increase, right? There's another thing to consider too, okay? So you have a lot of ships that are very old. So the last super cycle in shipping, a tremendous amount of ships were ordered, and those are reaching obsolescence. So an average oil tanker's effective age, it's how long you can use it, lasts somewhere, depending on your market, between 20 to 25 years, right? So if we're thinking about a replacement rate, what percentage of ships can you accommodate to break even in terms of a fleet percent over time, to break even in terms of your ships? How much can you accommodate in a fleet percent so that over time you keep the same size of your fleet? That would be about 4 to 5%, right? One ship, if it lasts 25 years or 20 years, every year to break even on ships, you would have to have 4 to 5% fleet replacement rate, right? So this delivery schedule, this fleet percent, is taken over 3 years. So if you think about it like that, is the fleet percent growing? Yes. Is it look good to see as an investor? Yeah, not really. But is it concerning at the same time? I would say probably no, because if and when the market does turn, these geopolitical considerations revert. Is there a lot of old tonnage in a bad market to be scrapped? Yes. Will they do that right away? Probably not, looking at their history, right? But over time, there is a lot of old tonnage in a poor market to be scrapped. Okay, this is taken from Edfin, who I would recommend if you're interested in shipping. Highly recommend following him. He does frequent and often updates on Twitter about shipping. I've been following him for years. Again, highly recommend. This is a chart he took from Cleaves. They're estimating the values of these shipping companies' assets, how they think the market, based, I think, on current conditions, how they'd be valued a year in the future. And what I really wanted to show you guys with this chart, what I wanted to look at was, where is it? The price to NAV, okay? So this is Ardmore Shipping, Double Hull Tankers, Frontline, INSW, Nordic Americans, OAT, Scorpio, T&K Tankers. And we look at their price to NAV. Well, the average of all of these stocks now is what I would say they're fairly valued. They are pricing their assets on these stocks at, the stocks are valued at what their assets are currently worth, right? And when we look a couple of years in the past, all of these stocks were, the price to NAV were way lower, right? So I don't know exactly what they are from memory. I'm pretty sure Frontline, even though today it's got that Fredrickson premium above NAV, I'm pretty sure it was trading below NAV. I'm pretty sure TNK was trading at a fraction of its assets, even though today I'm pretty sure like TNK was like 0.3 NAV. Like the market was that bearish on this company. I think Scorpio Tankers was at some point similarly valued, right? So we're looking at all these stocks today. We're looking to try and, if in terms of from an investment perspective and discount, they don't really look that interesting, right? They're priced at their assets value. And so the other side of that now that the stocks are fairly valued in terms of their assets, well, the other thing that has changed is that the assets values themselves have also changed, right? So we've gone, like I mentioned, in 2020, 2021 to real low in terms of the shipping prices to buy a new ship. This is a chart taken from Hunter Group, and we're looking at VLCCs, which is one of the biggest, well, the biggest ship in the oil tanker market. And we've gone from extreme lows in terms of pricing for these ships to relative highs, right? We're not at all-time highs. Could they continue to go up in terms of price? Maybe. I have no idea. But if we're looking at it objectively, are they cheap anymore? I think it's hard to say that they are. They're not cheap anymore. So it's when you're thinking about these stocks in terms of price, it's not only are they being the price to those assets being valued fairly, but the assets themselves are probably overvalued, right? Or slightly overvalued. Again, could they continue to go up? Yes. Could they go down? No, right? We're playing a game of unknowns, right? And so I think if we're trying to make money realistically in shipping over long periods of time, if we want to keep playing this game, we want to be trying to buy ships cheap, or at least the stocks when they're cheap. And I don't really see that opportunity in this space where we are today anymore. And because there are so many geopolitical unknowns that I think are driving the market, unless the supply and demand fundamental conditions, for myself, I have decided about 6 months ago at the beginning of the year that I am no longer interested in an investment in this space, and I have sold my tanker stocks. So I'm no longer involved in the space, but again, I do see compelling cases on the supply side where if there is a sell-off at some point in the future where the stocks underperform, they do poorly, these asset prices, if they're going to continue if for some reason they were to drop significantly, I would consider buying these stocks again. One final note, on this topic real quick, even though these asset prices in VLCCs and all tankers, right? This is a chart reflecting a similar trend across all of the ships in tanker land. Even though this has gone up so much, this isn't necessarily reflected in the earnings of VLCCs. So this is an interesting dynamic that I've noticed. What's driving this, at least for VLCCs, is that the shipyards don't have slots, right? So because there's so much competition to build ships from other segments, they have to charge a high cost, right? And where you are in the VLCC market, at least in terms of earnings of these giant ships, it doesn't make sense to order a ship. And that is reflected, I think, in the order book for this specific type of ship. So I would say that if I was going to buy, despite all of what I just said, if I was going to buy one tanker stock to hold for the foreseeable future, at least, it would be double hull tankers, DHT, because there isn't significant ordering taking place in VLCCs. They haven't benefited in the same way that the other smaller segments have. And the price, even though the stock is valued on this current price, their price to NAV is based on their ships, the VLCC market is in some kind of deadlock, right? That's just some thoughts I'm spitballing as I've been looking at it. But do I currently own DHT? No. So it is something that I'm keeping an eye on. If these stocks get cheaper, I will buy them again. But where we are now, there's too many unknowns for me. I'd be curious to hear your guys' thoughts, and let me know in the comments below. Have a good one.